All right. Good morning, everybody. Let's get the last of this. So I posted the spot gamma from last night. I don't have the AM edition yet, so I can't share that. But they did provide, as they usually do, different examples of how you can use their tool. Because of course they're always trying to, help people understand how to use this complicated tool. But they like calling out different signals as well. Yesterday we had this choppy cluster around lunchtime, and then we broke out of that, made a move to the downside, and had a really nice reversal. This flush reversal that they were talking about, if you haven't read it yet, it's worth a read. It lines up with a really nice 3-bar swing low, a textbook signal yesterday. It was beautiful, perfect. So it's nice to see confirmation from different tools, right? Different sources, different resources, but the same confirming signal. That reversal off of the low yesterday was fantastic. Hopefully you were able to recognize it through one of your own signals. There's so many different ways to spot it, but it's worth a read if you haven't checked it out. And of course, when I do get the AM edition, I'll share it. We've got some big things on the table today. The GDP numbers are the biggest, but we also have a lot of Fed speakers. They're going to go into blackout mode soon, so they want to get their opinions out there before that happens. And then, of course, once they're in blackout mode, Yellen loves the idea that she doesn't have to share the stage. She doesn't have to share any spotlight. And so we're likely to hear more from her. And it very well could tie in more with this partial government shutdown threat, which is looming. Moody's already made it clear that if there is a government shutdown, they're going to downgrade our credit rating. So we'll see. It's just another brick in the wall of worry. UK is down the most, nearly 0.75%. Right behind that, the small caps. Any progress made yesterday in small caps seems to have just been washed away. Japan down 0.5%. This continues to be a greater threat in the big picture. It's just really hard to see it. This is a sea change. They got a new governor. I'm not even going to try to butcher his name. And they're really looking to change a policy that's been going on for a long time. So we got to continue to consider what's going to happen if US dollar Japan breaks through that 152 and continues to the upside, and they don't do intervention. There's a lot to unpack there. NASDAQ down a little more than a quarter. Anything coming out of Hong Kong as for STIMI continues to just be like raindrops in the ocean. It has no effect so far. And the S&P down the least of the US markets at 0.25%. So GDP numbers, first revision, you can see that both sides are the same number. We'll see if anything comes in amiss. This is likely to shake markets to their core through the rest of the day. It's a big deal. At the same time, we're going to get inventories, and then we're into the Fed speakers by the afternoon. Remember, Market Watch doesn't put things on here unless they think it's a big one, right? It's not like when you go to FX Street and they're trying to list everything that they can think of. Market Watch keeps it dialed in and really just shows you the biggest ones. And so when you see so many big ones all at once, that alone tells you it's going to be a big day. So we do have a lot of Fed speakers, not just in the US, but around the world, including Bank of England. Tonight, we're going to get a lot more data out of Japan. So something else to be mindful of. Doesn't look like we have any more auctions, at least not today. But it's Wednesday, so we're going to get some crude numbers. And one of the things you want to look for, or just kind of, be mindful of, is the strategic petroleum status. Where are we at? So normally when we talk about a liquidity gap, one of those mornings, it's usually a CPI or a PPI, maybe non-farm payrolls. But I think today we have that on the table, right? It's not a CPI or a PPI morning, but the opportunity for a liquidity gap, I think we got a shot at it today. This is what the market's been waiting for, this sideways week where we have not hit the ADR levels Monday and Tuesday, and yet we already hit the ADR levels in the overnight hours. We're at the ADR half. The reason I came over to TradingView real quick is I can show you, looking back, these different ADR days. On Thinkorswim, I can only show you today's. So, it doesn't have that look back period. But Monday and Tuesday, we didn't hit the ADR levels. And remember, hitting that ADR is the average thing. It's the common thing. It's the average daily range. So we've failed to even range up and down to a 1 month average. That's compression. And at some point, we come out of compression with a big move. Now, after the big move of last week, where we expanded through the red all the way through the yellow and made another, practically another ADR higher, that was a huge record-breaking move. So it makes sense that there's just going to be some digestion, but 2 days without hitting that ADR, and we've hit it this morning. One thing about hitting the ADR so early in the morning is that it gives us the opportunity to hit the other side by the end of the day. Now, you might hear me say that and think, oh, we're bullish. It's not what I'm saying, right? Sure, this time we're on the lower side, and so that could mean we would go up to hit the other end. Doesn't necessarily make me bullish. It's the concept. We could have hit the upper end, and I'd be saying the same thing, and we'd be looking to the downside. Remember, price has to move most of the time with pullbacks, right? We don't want it to just sink like a stone. So it's supposed to ebb and flow with pullbacks. Even if we're going to continue this move to the downside, we would still expect pullbacks. Me and this pen lately, going to go round and round. So, price isn't supposed to just go in a straight line. It's supposed to pull back. One thing that really stood out between the spot gamma levels is the put wall. And I double checked. I went and got yesterday's levels and put them back on just to make sure that I was right. This put wall was a lot closer to us yesterday than it is this morning. They rolled it down, and that's bearish. They're giving themselves room to the downside. Now, we don't have Spot Gamma's notes for this morning, so I don't know if they're going to address it and talk about it, but they didn't move it just a little bit. Did you notice how far I had to scroll to get there? It's at 4,500. We're at 5071. You're looking at a 500-point move to the downside. Now, I'm not saying we're going to make that move today. Come on. We could. Don't get me wrong. We could move there today, but that's not on the table. Just the fact that they moved it down that far. We still have the call wall at 51.11. That's the COG line. We're still underneath the previous week's close. We've already cut through our daily pivot point. We had an inside day breakout, which we've recovered from, and that's a textbook double bottom. Remember that double bottoms and double tops are traps. It's what they're designed to do. So when you have a double bottom in this case, you don't want price to come back down to the previous bottom and bounce on that level. Not if you're bullish. If you're bullish, you want this to cut through that level so that it can trap those bears and then get the rug pull, pop to the upside, squeeze their heads, make their heads explode. If you don't get the breakthrough and the extension beyond the previous pivot point, then there's no trap and there's no catalyst to help push price in the other direction to get that reversal lifted off. Now, don't get me wrong, you can bounce perfectly and go up, but that's not the base case argument. When we bounce right on the line perfectly, most often that's just a pullback before we continue lower because it makes a really nice cup and handle inverted in this case. So bouncing perfectly and lifting to the upside right on the line is an inverse cup and handle. It's a continuation move for the downside, cutting through the previous pivot and extending beyond it some, like we did here. That's a stronger signal for a reversal. But there's always the argument of, well, how far past the pivot point are we supposed to look? Because if this was a true breakdown, then we would break that pivot and we would continue moving to the downside. How do we know when it's one versus the other? Well, I mean, you don't have to guess. You could just let it turn around and come back up. If it is a reversal, we're going back to the top. So there's plenty of room here. No reason to jump the gun and get in early. But also, even if you didn't have any signals, getting in along these lows is your least risky trade, dollar-wise. It may be a risky proposition to go long without a long signal, but you would risk the least amount of money going long down here. The textbooks will tell you that your stop goes underneath this low. They're going to tell you that if your entry is there or if your entry is way up here, the textbook is still going to tell you your stop goes way down there. Now, I trade futures, and I know a lot of futures traders, and I don't know very many that would actually put their stop way down there when they're getting in way up here. There's a couple, don't get me wrong. Most of us aren't going to do that, right? We're not going to use 8 and 10 and 12-point stops just to follow the textbook's definition of where a stop should go. Just saying, this concept and logic holds true. If you're getting in along the lows, you're getting in at the least riskiest point, even if you didn't have a reversal signal. So we're flirting with the volatility trigger this morning. And with the put wall rolled so far away, it's really just beyond our sight at this point. We won't even focus on it. We're still holding above the weekly pivot point, but not by much. And we're still holding above the three-week moving average, which keeps us still in a bullish posture. Being above the weekly pivot point is bullish, and being above the 3-week moving average is bullish. We can be bullish all we want, but when price continues to fall like this, you got to really consider where's your bullish opportunities, right? So when I was newer, I always hated it when somebody would say something simple like, well, we're above a weekly pivot point, so we're bullish. And then I'd sit and watch price do that. And I would think that doesn't feel very bullish, bro. It doesn't feel very bullish at all. But the logic holds true. We're supposed to be bullish above the weekly pivot. If price never gives you a bullish signal, then you just never got a bullish trade. Because at some point, any comment like that, oh, we go long above the weekly pivot, has to be offset by at some point we pull back. So I mentioned a liquidity gap opportunity this morning. I wasn't prepared to show a liquidity gap example, but we've had liquidity gap opportunities lately. It shouldn't be that hard to just scroll back and find one. See if I can dig one out here. This is a liquidity gap. This is what we're looking for. Now, it doesn't matter which direction it goes. I've got two examples here. One is bearish, one is bullish. It is a single directional push. If the push is strong, it can be multiple candles like we have here. 8:30 print, the market goes in one direction. We don't want big wicks on each side. We want a single directional push. Notice there's almost no wick to the bottom of this. We got the data and price went straight up. Over here, we got the data, price went straight down. There was no wishy-washy ambiguity. We didn't go in different directions. So very clear signal. We get the data, price picked one single direction and moved it that way. Then it bases, comes back down and gets the gap closed by around 11 o'clock. I know that might sound a little odd, but I say it all the time, watch the clock. So this top example, we got back to the gap close around 11. Another example where we went to the upside, we got back. Actually, we flipped by around 11. We got back a little sooner, 10:30 or so. Same thing here, got back a little sooner, but close to 11 o'clock. So it's not arbitrary. This is what we don't want to see. We don't want big wicks on each side. If we get that, we just don't trade a gap close pattern. Doesn't mean we can't trade at all. We just ignore that setup. There is no setup if we get the big wicks on each side. All right, simple enough, pretty easy. Nothing to it. We have that possibility today. Generally, it's CPI, PPI, non-farm payrolls. But I think this morning we have that opportunity with the GDP. We have volume this morning. It's the first time this week where we really had any volume. 56 on Monday, 60 on Tuesday. We're at 100 today. That's nearly double of what we had Monday. So the volume is back again. But the volume is back again with this deep move to the downside. And that makes sense because generally when we get moves to the downside, we get elevated volume anyways. So it's kind of par for the course. On the week, we already mentioned the week's close. The previous week's close is overhead, but it's easier to visualize. We're nested nicely inside of last week's range, and we're still holding above the 50% mark. But now that we've made these bigger moves to the downside, it doesn't hurt to recenter our attention to that halfback level. 50.41 is the halfback for the whole week. $50.61 is the halfback from that really big bar. We would want both of those halfback levels. Now, if we continued to fade to the downside, we could measure from, say, this last wick low all the way up to the high and get another half back level. But doing that this time actually lines us up on another pivot anyways. So not really all that helpful. Could pick this back one, I guess. Just because we haven't been out here for a while, let's take a look at the monthly, same thing. Nice, clean breakout, good follow through. There's no candles around to measure that would help us out up there, right? Blue skies, just nothing up there. We're close to the 10-period daily moving average. The 10 is kind of a big deal, and it lines up on a round number. It's not spot on perfect, but there's two of them here. I got the EMA and the SMA because it just kind of solves that argument of should I be using the EMA or the SMA? Use them both and just quit worrying about it. At some point, you're going to notice if you have them both on your chart day after day after day that they're so close together, there's really no reason to stress over either one. And then you can finally sleep at night and quit thinking about it. It's what I think about. Nerd. So 50-51, it's right underneath us. It's something to consider if we do continue this move to the downside. We still don't have much on the profiles yet. It's not a classic D or anything else. We don't even have a B just because we have this weird odd shelf here in the middle. But we're going to lose more of the volume today on this lower end. And what we want to see is that this point of control is going to move, or it likely is going to move. We still have volume from over here, but I don't think that's going to be enough. So this volume back here and this volume right here is why we have this point of control where we do. If we lose these candles throughout the day today, which we're going to do, every new candle we get on this side takes a candle off of that side. So we'll get through this big liquidity gap there. Finish up with the volume. That should move our point of control, and it will now be over our head at 5,100. So we'll be under the point of control probably by the end of the day. The only thing that would prove me wrong is if the bulk of the volume that's down here on the point of control actually came from this day, not from that day. And I don't think it did, but if we wanted to, we could go into a TPO chart and we could go back to these days and we could look to see where that big volume came in. So, I mean, if we wanted to research it, we could dig deeper and find out. I don't need to. It's not that big of a deal. So I'm just going to let it go. My assumption is by tomorrow when we do the morning briefing that the point of control will be over our head at this level up here, 5,100. And the only way that that wouldn't stick at this point to me is if we break our current low, move to the downside, and we get into this 50-25 area, and we build volume out at this level by the end of the day today. That could do it because then we wouldn't move our point of control to 5,100. We would move it to 50-25. And that would make sense if we fall down into an iceberg. It's the point of control for the TPO. It's that blue profile here on the side at 50-25. So it makes sense if we revisit that area that we could find enough volume there to move the point of control up to that point. Otherwise, by tomorrow, it should be over our head. We don't have a new point of control of like a VPO or a VPOC because we've already cut through this zone. Now, I've made concessions to this in the past, and it's something to consider if you don't have your own approach yet to these point of controls and value area highs and value area lows, the textbook will tell you to carry forward that point of control, whether or not we've hit it, period. Just carry it forward. I've got enough pivot points. I don't need to carry it forward just for GP every day. That doesn't mean that you couldn't or that you shouldn't. And on the other side of that, even if we've already hit it, we've hit it in the pre-market. That doesn't bother me, but a lot of analysts will say, well, it doesn't count because it happened in the pre-market. I don't subscribe to that, but that doesn't mean, again, that I'm right and everybody else is wrong. You could subscribe to that. And so if you hold to that logic, even though we've hit it here, if you say it doesn't count because it happened in pre-market, you would want to leave it on through the day today. And if you don't have a dog in this hunt, right, if you don't really care one way or the other, put it on there. And if we make a move to the upside, see how price responds around that level. At the very least, you'll gain some insight about price and the VPOC level. That's if we make a move back up anyways. But for me, I'm only keeping point of controls that have not been hit. And the rare occasions that I leave it on a day like this is if I'm specifically looking for price today only to come back up and hit that level. Like this VPOC up here, I won't move it until we hit it. This one, there's been exceptions where I'll leave it on just for the rest of the day and take it off because it has been hit. I don't want to keep it, not for any day past today. All the volume so far from the overnight hours is still across the top, which makes sense because we spent the most amount of time there. But you can see that we've got a lot of volume down here, almost enough to move the point of control down to 50.72. But we have not spent even half the amount of time there that we did last night across these highs. So we've picked up a significant amount of volume along these lows. Notice it wasn't as great below yesterday's low as it was above. They really defended this move to the downside, or at least defended it on the way back up, right? We moved through as a really big candle. We cut through there really fast the first time. It's very likely that we got into some liquidity. We came back up above that pivot point and we got into some liquidity up here after we had already dropped through it once the first time. So what that tells us is there's a wall of trading going on, or a ceiling of trading that wasn't there as support, but it is there now as resistance. See, we get a lot of information out of these things. Now, we could turn on a different chart, like a footprint chart, and prove that theory, because right now it's just theory. We don't know if that big bar had all this liquidity there or not. I say it didn't. That we cut through and it was very shallow, and as we came back up, we found a wall of sellers overhead, or a ceiling, if you want that word. $50.35 is the lower edge of the weekly expected move this week. We're 2.86% above the 10-week moving average. We are a little bit on the decline. We haven't been back to the 10-week at all this year. The last time was back in November, right after we got QRA, October 31st, November 1st, right back here, QRA, and we never looked back. So it's been a long time since we've had any reset to the 10. We've come close, trying to fade back, got around 2%, and then just rallied back off again. So kind of on watch to see if we can get below that 2% marker. That would be interesting to see. The last time we got that close, it was near the last FOMC, right? No, the last FOMC was late January, 1st of February. So that would have been, now we were on our way back up by that point. So never mind. And for the 10-day, we're just barely a quarter above the 10-day. We've had a couple of crisscrosses already this year where we've ducked below the 10 and came right back up. But I'd say we've developed a very strong zone to the upside. And really, these higher lows on the bottom side has started to change a little bit. This last one is deeper than the previous one. So we were getting these higher lows, and now we've kind of turned a corner. It's interesting to see if we're going to start to actually curve over and start getting deeper moves behind on the bottom side of the 10. For now, just getting back to the 10 would be kind of the target or the goal. In the last 5 days, technology and consumer discretionary still have the greatest change. And look at their charts. That white dotted line is linear regression. The orange line is a 50, and it's just this solid structure. The same thing with XLI. So really, those four have very similar charts, but you can go down to XLV and you have the similar chart again, right? So that's now 5 out of 9 that have that very strong angle and very sharp 50-period moving average. 5 out of 9, and some of them are in the defensive category. But when we look at some of these others, utilities is the only one pointing to the downside. And even it was up over the last 5 days with a positive move of 1% or more. This is the only one with a downward slope. 50 is underneath the 200. On XLP, staples, we have a 5200 cross, and we have that nice 45-degree angle. I know it's not a true 45, but from left to right. And I think this is a really nice example of that wave form, right? Just like textbook 101. It doesn't get much cleaner than that. Apple's holding up better than some of the other things out there this morning. So looking at the ES, the NASDAQ, both of them made it down to the ADR half. They're both underneath this 3-day moving average. Obviously, they're underneath VWAP. 10-year also underneath the 3, but holding above the 10, just like the NASDAQ. But we can see in the dollar how we were fighting that 3-period moving average, and we finally got a breakthrough. We're through the 3 and we're through the 10, and we've even buzzbeat off of it. We came back down and tested it. Remember, buzzbeat is when price is testing resistance, finally makes it through resistance, and then pulls back and tests that old resistance as a new support. Rather than saying that whole long sentence, we just say it was a buzzbeat. US dollar Japan kind of gave us that buzzbeat, but it's a little sloppier. Back here with US dollar Japan, notice the 3 is still above the 10. So it was a short duration cross through, drop below the 3, drop below the 10, quickly reversed and got back up. With the dollar, the 3 is underneath the 10. So the dollar stayed down long enough for the 3 to get underneath the 10. Now we're looking at a 310 cross back up. That's part of a surge signal. The last piece for that trigger is for the 3 to get back above the 10. But just having price cross through the 310, that's the surge signal. It's the start of it. We got bonds here with the 310 cross. The 10 is above the 3. 3 tried to cross over, and we're just tangled up in this big mess. So we need price to get back above like it did back here, and then keep it and continue that move to the upside so that the white line can get above the blue line and start following it up. It's kind of that cross up that we're looking for on the dollar. It's almost like a TRB setup, but we never really focus on, like a TRB on the dollar. Still, you've got a very tight range, like an IX10 basing pattern. This is all the hallmarks of a TRB setup. The thing is, if it was a TRB, then this candle, which is today's candle, it's going to get above 104.5 and get a lot closer to, say, 105 by the end of the day. It's what makes TRB trade setups so good, right? This space is what we look to get completed in a single candle, whether it's a daily candle, a weekly candle, hourly candle, it doesn't matter. This breakout bar is supposed to encompass almost this entire move in one day. So that's why I like them so much. TRB, trendline breakover. So we've got that setup occurring on the dollar, and that's the call right now. What's going to make the dollar get above 104.5 today and get maybe all the way up to 105 today? And how is the rest of the market going to respond to such a strong move in the dollar? For the 10-year, we've been holding inside of this really big bar back here. But you can see how we're holding in the upper portion of that really big bar. Because we were able to hold in the upper area like that, it remains bullish, and we're just looking for that continuation, that breakout and expansion. So with that expansion in mind, where's the target? Well, we just talked about the dollar at 104.5, maybe even at 105. If we got a dollar moving to the upside and we get the Dixie moving to the upside, what's that going to do to the S&P and the NASDAQ? Measured move, just capturing all of this and projecting it upwards, 50% is 4.432. The 10-year above 4.36 is going to be impactful, but 4.4? Yeah, markets aren't going to like that. Even if we adjust this and only use this smallest range here, $4.439. So we need to get the data. We get the GDP numbers, watch the 10-year, look for this breakout, but keep your eye on the dollar today. And then, of course, we got US dollar Japan. One of the easiest things you could think about when it comes to using US dollar Japan, if you just want a generic idea of how to use this, think of it as the dollar and the 10-year combined. It's not that, but it's a nice generic way to kind of think about what it represents. There's a big move. A sharp reversal. So we're looking at the 10-year for Japan rather than the 10-year for the US, right? We've got our line in the sand, kind of needs to hold. So we saw that little bit of a move to the upside, and it was just immediately rejected with that sharp reversal that continues. It's not done yet. We had this nice clean move to the downside. Something reversed that, and now that got washed back out. So things are starting to get a little violent. I would expect that this violence is going to pick up. Keep your eye on the clock, GDP, and then Fed. Everybody be careful. And I will see you all tomorrow.